Okay, imagine this. A company, right? It's gone from losing money, like consistently, to generating some really impressive profits.
Yep.
And it's standing right at the epicenter of this whole AI revolution. Sounds pretty intriguing, yeah.
That always sounds like something you'd want to look at.
Especially when its stock is trading way below what analysts think it's actually worth. But here's the twist, the puzzle.
Okay.
What if the people who know the company best, the insiders, executives, board members, what if they're selling off of their shares?
Yeah.
Like a lot of them.
Okay. That definitely adds a layer of complexity. High stakes.
Exactly. High stakes, maybe high reward. We're going to try and untangle that mystery today. Welcome back, everyone, to the Deep Dive. This is where we take complex info and, well, try to make it clear, give you insights you can use.
That's the goal.
Today, we're diving deep, really deep, into Innodata Inc., ticker symbol's INOD. It's on the NASDAQ. And they've been making some serious waves in the generative AI space.
Right. And our mission today, basically, is to put Innodata through kind of Warren Buffett stress test. Rigorous.
Okay.
We're looking to see if it genuinely has what Buffett calls a durable competitive advantage and, a clear path to making money long term.
Sustainable profits.
Exactly.
Okay.
And just so everyone knows, all our analysis, it's based on data from August 29, 2025. That's when the stock closed at $37.98.
Yeah, and this whole deep dive, it's built on a really comprehensive report. It's called Innodata Inc., Deep Stock Research.
Packed with detail.
It really is, packed with insights, and we're here to kind of guide you through the most important bits, the key takeaways. So, to make sense of all this, we've split our deep dive into two main parts. Makes it easier to follow.
Good idea.
In part one, we'll get into the company's business understanding, we'll look at management evaluation, and then the financial analysis, the numbers.
Fundamentals.
Right. Then, in part two, we'll switch gears. We'll look at market sentiment, what's the buzz, ownership structure, who actually owns this thing, a proper risk assessment, and then wrap it all up with our conclusion. Just a quick note before we jump in, really glad to have you here with us.
Yeah, thanks for tuning in.
If you're finding this deep dive helpful, please do like and subscribe to the Stock Analytics AI YouTube channel. It really helps us out.
It does.
And for members, it's just €4.99 a month. You get priority deep dives on specific tickers you might be interested in. We're actually planning to cover all of the S&P 500 stocks over the next few months.
Big project.
It is, and members get that exclusive priority access. Oh, and if you just want a one-off deep dive on a stock you care about, you can always drop us a super thanks. Okay, let's get started. To really understand Innodata, we need to begin at the beginning. Let's kick off with Chapter 1, Business Analysis Report. So at its heart, Innodata's whole mission, they say, is to wrangle messy, unstructured data into useful, high-quality information.
Right. Wrangling data. I like that.
Great, me too. And they do this using a mix, kind of a blend of AI, sophisticated AI, and crucially, human experts.
That human element seems key here.
It does. It's not just basic data entry, It's presented as a high-value service, and it's powered up by their own tech.
Yeah, and what's really interesting is how they've set up their revenue. Three main streams.
Okay.
Their digital data solutions segment, they call it DDS, it's the real engine room. It generated 58% of their total revenue in Q2 2025. Huge chunk.
Wow, more than half. What does DDS actually do?
Well, it's all about getting data ready for AI models.
Yeah.
So preparing it, labeling it, curating it. This includes stuff for cutting-edge generative AI, supervised fine-tuning,
Right.
and also this really important process called reinforcement learning from human feedback. RLHF.
RLHF. That sounds technical. What is that in simple terms?
Think of it like teaching the AI by having humans constantly give it feedback. Like, no, that response wasn't quite right. Try this. Or, yes, that's better. It helps align the AI with what humans actually want and expect. It's like coaching.
Okay, so direct human guidance for the AI. Makes sense. And they also do something called red teaming for model safety.
Yeah, that's crucial. Red teaming is basically stress testing the AI. You intentionally try to trick it, find its weaknesses, its biases, vulnerabilities before it gets released to the public.
So trying to break it to make it stronger.
Exactly. Hugely important as AI gets more powerful. And they back all this up with their own software platforms like the Gen AI Workbench and an annotation platform. Proprietary stuff. And if you zoom out, look at the bigger picture. Innodata, right, it's still a small cap stock, market cap around $1.22 billion.
Relatively small in the tech world.
Yeah, but get this. They count 5 of the Magnificent 7 tech companies as clients.
5 out of 7, that's huge.
It is. And they have this global workforce, over 5,000 in-house subject matter experts. That suggests they have some really specialized knowledge, something even those tech giants can't easily just build themselves. It really validates what Innodata offers.
So their value proposition, it seems pretty clear then. It's this blend of scalable AI workflows, so the tech side, plus hands-on quality control, the human side.
Best of both worlds, maybe.
Right. And they have this 35-year history dealing with quality data. You think about it, for these big tech companies, an AI model that goes wrong that could cost billions. Reputation, lawsuits, everything.
Absolutely. Massive risk.
So Innodata's ability to kind of de-risk that AI development using this human-in-the-loop system, that must be incredibly valuable to those clients, right?
Okay, now let's broaden the view a bit within this chapter. Let's talk about the industry analysis. The market for AI data is just exploding.
It really is. Unbelievable growth.
And Innodata isn't just, floating along. They seem to be actively grabbing market share. Their annualized sales growth is 32%. The market average is, 8.1%?
Of difference.
Yeah. And management's actually guiding for organic revenue growth of 45% or more in 2025. That's
Ambitious.
very ambitious. Which naturally leads to the question, what about the competition? Because it's got to be fierce.
Oh, yeah. Big names out there. Microsoft, Unisys.
Right. But something interesting happened recently. Meta bought Scale AI,
Scale AI. They were a big competitor, weren't they?
a major one. And that acquisition, according to the report, has disrupted the competitive landscape. It's created these near-term growth acceleration and market share opportunities specifically for Innodata, especially with those large tech clients who might be reevaluating their options now.
So a competitor being bought out actually creates an opening for Innodata. Interesting dynamic. Now, speaking of potential problems, the company did face a class action lawsuit.
That's usually a red flag.
Usually.
Yeah.
But here's where it gets really interesting potentially. Both the DOJ, the Department of Justice, and the SEC have closed their investigations related to those lawsuit allegations. And crucially, they did so without recommending any enforcement action.
Okay, that's significant.
It feels significant. Does that dismissal sort of, suggest the underlying business was found to be legitimate? Does it add a kind of reputational shield?
I think it has to be seen as a positive. It's a major de-risking event. Doesn't make the lawsuit disappear entirely, but having the feds back off is a big deal.
Right.
And this ties into their competitive advantage, their moat, as Buffett calls it. It seems multi-layered.
Okay, like what?
Well, you've got that long-standing reputation, strengthened by this DOJ-SEA outcome. You've got the client list, those 5 magnificent 7 names we mentioned, huge validation.
Okay.
Then there's the operational side. Their operating margins have expanded dramatically. Management points to their scalable automated workflows for that. Basically, their tech lets them handle more work without costs rising proportionally.
Operational leverage.
Exactly. Plus, they focus on sticky long-term contracts.
Yeah.
This creates high switching costs for clients. Once a big company integrates Innodata's systems and data flows, ripping that out and replacing it, it's expensive, time-consuming, risky.
So they lock clients in to some extent.
To a significant extent. And then, maybe their most unique assets. Those proprietary software platforms we mentioned earlier, and that huge global network of over 5,000 in-house subject matter experts. That's hard to replicate.
Okay, that gives us a really solid picture of the business and its market position. Now, let's look at the people steering the ship. We're moving on to Chapter 2, Management Evaluation. And we'll start with the leadership assessment. Innodata's story, it really is a turnaround story, isn't it?
Quite remarkable, yeah.
The CEO and co-founder, Jack Abuhoff, he took a company that was loss-making 5 years ago and transformed it, pivoted right into this hot AI data engineering space, and now it's making significant profits.
That takes vision and execution. How did he pull that off? What's their secret?
Well, one thing that stands out is their track record. Quarter after quarter, it seems to be beat and raise.
The classic sign of strong management.
Right. They exceed what analysts expect, and then they increase their own forecasts for the future. Like recently, after a strong Q2, they bumped up their full-year 2025 revenue growth guidance to 45% or more.
That signals real confidence, doesn't it? It suggests they know their business well, they're executing strongly, and maybe they're even a bit conservative with their initial forecasts, setting themselves up to impress.
Consistently under-promising and over-delivering. Investors usually like that. So with this turnaround and growth focus, how are they actually allocating the money they're making? What does their capital allocation strategy tell us?
It tells us they are laser-focused on growth, hyper-growth, really.
No dividends, then?
Nope, no dividend. Their main goal, they state, is to reinvest a portion of our cash from operations back into the business,
Where specifically?
specifically targeting technology development, improving those platforms and strategic hiring, getting the right talent. It's all about fueling that long-term growth engine. And when you look at their balance sheet, you see they have the firepower to do it. It's like a fortress.
How so?
They have a net cash position of $55.57 million. That means more cash than debt. Plus, they have an undrawn $30 million credit facility, basically. A loan they can tap into if needed, but haven't.
So tons of flexibility.
Huge flexibility. Now, one point to note. Shares outstanding did increase by about 9% last year.
Dilution. Shareholders don't always love that.
True. But in this case, given their surging profitability and, critically, their incredibly high returns on the capital they invest, you can argue that this dilution is justified. They're raising capital, yes, but they seem to be putting it to extremely productive use.
And this brings us to a really striking point. Their return on invested capital, ROIC, it's an outstanding 40.11%.
Wow, that's very high.
Very high. The market average is around 12%, and their return on capital employed, ROCE, is 41%. The industry average for professional services is only 14%.
Okay, those numbers are genuinely exceptional. That's a powerful signal of, well, potentially a very high-quality business with a strong competitive advantage.
It definitely screams quality, but, with returns that high, you have to ask, are they sustainable? What are the risks? Could competition come in and just erode that super high profitability?
That's the million-dollar question, isn't it?
Yeah.
Sustainability. Those high returns absolutely attract competitors like moths to a flame.
Right.
For Innodata, the argument for sustainability rests on that unique combination we talked about. The proprietary tech plus that deep bench of human experts. It's not something rivals can just copy overnight.
Hard to replicate.
Exactly. And those sticky client relationships, the high switching costs, and they also act as a buffer, protecting those margins, at least for a while.
Yeah.
But yeah, maintaining a 40% ROIC long-term is incredibly difficult. They'll need to keep innovating.
Okay, let's transition now into the numbers themselves. We're diving into Chapter 3, Financial Analysis. And let's start with a key metrics review. So, market cap, $1.22 billion. Still technically a small cap, as we said. But the financials, they tell a story of just powerful, really rapid growth.
The growth is undeniable.
Revenue more than doubled in the last year. Q2 2025 revenue was $58.4 million. That's up a staggering 79% compared to the same quarter last year.
79% year over year. That's hyper-growth territory. And what's maybe even more impressive is the profitability turnaround.
Yeah, tell us about the margins.
Okay, so gross margin is strong at 41.99%. Operating margin hit 17.47%, and net margin 18.71%.
And how does that compare to, say, 5 years ago?
Night and day. Their 5-year average operating margin was less than 1%, often negative.
Wow, from under 1% to over 17% operating margin. That's huge expansion.
Huge. And it ties back directly to that operational leverage we discussed. Their AI-human hybrid workflows are becoming more efficient as they scale. They're getting much better at turning those growing revenues into actual profit.
The implications of this are pretty significant, wouldn't you say? Maybe the biggest milestone financially is that they're now free cash flow positive.
Absolutely critical turning point.
They generated $36.07 million in free cash flow over the last 12 months, PTM. That means no more cash burn.
Right. They're generating enough cash from their operations to cover their investments and still have cash left over. They can fund their own growth now. That's a massive signal of financial health and self-sufficiency. Which leads us to think about financial stability. How solid are these improving financials?
Well, one indicator is their consistency. Innodata has beaten analyst earnings per share, EPS, estimates in each of the last 4 quarters.
Okay, so they're not just meeting expectations, they're exceeding them consistently.
Seems like it. And turning a net loss into a profit, and then consistently beating forecasts. It suggests this isn't just a one-off good quarter. It points towards a strong, potentially sustainable trend driven by real operational improvements. And underpinning all this is that strong balance sheet we mentioned. Let's reiterate those strengths.
Yeah, worth repeating. Minimal debt. The debt-to-equity ratio is 0.05. Very low.
Healthy liquidity, too.
Yep, current ratio is 2.87, which is quite healthy. Indicates they can cover their short-term obligations easily. And again, that $55.57 million net cash position plus the undrawn $30 million credit line.
Loads of cushion. And still no dividend, consistent with that reinvestment strategy.
Exactly. All signals point towards financial stability and a focus on reinvesting for future growth. Now, let's connect this to the valuation analysis. This is where Innodata presents a really interesting, almost paradoxical picture.
How so?
Well, its current trailing PE ratio, price to earnings based on past earnings, is 27.63.
Okay. Is that high or low?
Compared to its own history, it's actually quite low. Its 5-year historical average PE was way up at over 104.67
Oh, so the PE has come down massively. Why?
because earnings have grown so incredibly fast. The E in PE shot up. So even with the stock price rising, the ratio itself came down. It suggests the valuation hasn't fully kept pace with the rapid earnings improvement.
Okay, but how does it look compared to other companies in its industry now?
That's the other side of the paradox.
Yeah.
When you look at its forward PE ratio based on expected future earnings, it's trading at 42.3x.
42.3. And the industry average?
The industry average forward PE is only 16.4x.
Okay, so compared to peers, it's trading at a really substantial premium.
Exactly. That tells you the market has baked in very high expectations for Innodata's future growth. It's pricing in continued strong performance. No room for error, really. If you were to build an educational discounted cash flow model, a DCF,
Which tries to estimate intrinsic value based on future cash flows.
right, you'd have to start with a very high initial growth rate, probably in line with that 45% plus management guidance, and then gradually taper it down over time.
Makes sense. What about the discount rate?
That would also need to be quite high, for two main reasons. The stock's high volatility, its beta is 2.76, meaning it moves much more dramatically than the overall market, and that customer concentration risk we keep mentioning. Both increase the risk profile.
So high growth, but also high risk factored in. What do the pros think it's worth?
Well, the professional analyst consensus, looking at their models, puts Innodata's estimated intrinsic value somewhere between $55 and $75 per share.
Okay, and the stock is currently at $37.98. So analysts see significant potential upside.
According to their consensus view, yes, a considerable gap between the current price and their estimated value range.
All right, let's quickly summarize those key financial and valuation metrics for everyone. Market cap, $1.22 billion. Trailing 12-month TTM revenue, $228.14 million. Trailing PE, 27.63. TTM free cash flow, $36.07 million. TTM operating margin, 17.47%. And that really impressive ROIC, 40.11%.
Good summary. Captures the highlights.
Okay, that wraps up the first part of our analysis. We're now moving into part 2 of our deep dive. We'll start with Chapter 4, Market Sentiment. Let's gauge the overall market perception. So what's the general feeling out there about Innodata? The report says it's overwhelmingly bullish.
It does seem that way, especially among analysts.
Analysts have a strong buy consensus rating, and their price targets. They range from $55 up to $74.
Yeah, that's a pretty unified positive stance from the sell-side analysts covering the stock. A strong vote of confidence. And what really reinforces this is the recent news flow. It's been almost universally positive.
Like what specifically?
Mostly focusing on those strong Q2 earnings we discussed, the company raising its own guidance, and announcements of major customer wins. Good news all around.
And the market reacted well.
Very well. The stock jumped, what was it, 13.22% in after hours, trading right after that Q2 report came out.
Okay, clear sign of enthusiasm, powerful demand from investors on good news. But let's dig into the market indicators a bit more now, because they paint a slightly, well, more complex picture, don't they?
They do. There are some contradictions,
Take short interest. It's sitting at 13.88% of the float.
which is high. Significantly higher than the peer group average, which is around 5.5%.
So what does that mean? It means a pretty sizable chunk of investors, likely sophisticated ones, are actively betting against the stock. They're borrowing shares and selling them, hoping the price goes down.
Right. It directly contradicts that bullish analyst sentiment and a positive news flow. You've got a tug-of-war happening. Although there's another wrinkle here. That short interest figure, while high, has actually fallen recently by about 9.34%.
Okay, so some shorts are closing their positions. Covering.
It could be interpreted that way, yes. It might be a bullish signal in itself. Maybe some bears are getting nervous about the company's strong fundamental performance and are cutting their losses or taking profits on their short positions.
So the short story is complicated, high, but maybe decreasing. And then there are the technicals, the moving averages.
Yeah, the price chart tells another part of the story.
The stock is currently trading below its 50-day moving average, which is around $45.73. And it's also below its longer-term 200-day moving average of $42.39.
That's a clear technical negative, generally speaking. Trading below key moving averages often signals short-term and sometimes medium-term bearish momentum.
So we have strong fundamentals, bullish analysts, positive news, but high short interest and the stock trading below key technical levels. How do you square that circle? What's driving this bearish price action? Is it just profit taking after the run up, or is the market worried about something specific?
It's likely a combination of factors. High-growth stocks like this are inherently volatile. So yes, some profit-taking after significant gains is perfectly normal.
Okay.
But the elevated short interest combined with trading below those moving averages suggests that a segment of the market remains skeptical. They might see the valuation as stretched, or perhaps they're more focused on those underlying risks we're about to discuss, more particularly that customer concentration.
Yeah.
It's a battle between the fundamentals and the perceived risks or valuation concerns.
All right, let's move on to who actually owns the stock. We're now in Chapter 5, ownership structure. And this area, well, it presents some genuinely mixed signals when we look at the stakeholder analysis. On the one hand, institutional investors, the big funds, mutual funds, pension funds, they hold the majority of the shares, 52.47%.
It's usually seen as a positive sign, indicates professional money managers see value.
Right. And big names like Vanguard, Northern Trust, they've actually been increasing their positions, buying more shares.
Which, again, seems to validate the investment case. These institutions do their homework, typically. Their buying implies they see a compelling future for Innodata. But, and this is a significant but, let's talk about insider holdings.
The people running the company.
Exactly. While institutions are buying, insiders themselves own a surprisingly small amount, just 3.90% of the company.
Only 3.9%. That seems low for a company led by its co-founder.
It does feel low. And what's even more striking is the selling activity. In the last 12 months, insiders have sold, on a net basis, over 2.1 million shares.
2.1 million shares sold by insiders.
Net selling, yes. And the single largest sale was by the independent chairman of the board. He sold $13 million worth of stock.
$13 million. At what price?
He sold at $65.25 per share, which is significantly higher than the current price, around $38.
Wow. So the chairman cashed out big time, near the highs, while institutions are buying now at lower prices. What do we make of that? It feels contradictory. That's exactly the word. It's the central dilemma here, isn't it? We always hear, oh, there are many reasons for insiders to sell. Diversification, buying a house, taxes.
The standard explanations.
Right. But the sheer volume of selling here, over 2 million shares net, and especially that huge sale by the chairman at a high price, it really forces you to question things.
You have to ask, do they know something the market doesn't? Or do they simply believe the stock ahead of itself, even if the long-term story is good? Are they just taking profits?
It definitely casts a shadow on the otherwise bullish narrative. Why are the people with the most intimate knowledge seemingly cashing out when things look so bright operationally? It's a major red flag to consider.
And just connecting this back, that concentration of ownership in institutions, combined with a relatively small public float, only about 30.6 million shares available for trading, that can also amplify the stock's volatility. Well, if one or two large institutions decide to buy or sell a significant chunk, it can move the stock price quite dramatically, just because there aren't that many shares readily changing hands. It adds to the choppiness.
Okay, let's systematically pull together the potential upsides and downsides. Time for Chapter 6, Risk Assessment. And we'll start this with a classic SWOT analysis, strengths, weaknesses, opportunities, threats.
All right, let's start with the strengths. We've covered many of these. First off, strong financial performance. You've got that substantial revenue growth and the dramatic turnaround to profitability. Excellent margins now.
And the efficiency.
Right. Exceptional capital efficiency, highlighted by that incredible 40.11% ROIC. Then there's the fortress balance sheet net cash, undrawn credit line, very solid financially.
What about the business itself?
A robust competitive moat that comes from their proprietary technology, the global network of over 5,000 experts, and their strong reputation, especially with those major tech clients.
Okay, now for the weaknesses. The big one seems to be customer concentration, right?
Absolutely number one risk, I'd say. Approximately 58% of their main digital data solutions revenue comes from just one customer.
58% from one client. Wow. What happens if that client leaves or decides to do the work in-house or even just significantly cuts back spending? That's a huge vulnerability.
It's a massive risk. While management emphasizes they're working hard to diversify, signing up new clients, investing in platforms, until that revenue mix changes significantly, this remains a major overhang.
Any other key weaknesses?
The valuation. As we discussed, it's high, it's priced for continued perfection. Any stumbling growth could hit the stock hard. And of course, that history of significant insider selling we just unpacked. It's a notable red flag clashing with the growth story. Okay, let's look at the opportunities. The market itself is a huge one.
The demand for AI training data.
Exactly, it's exploding.
Yeah.
That creates a massive runway for Innodata if they can capture their share. Also, that acquisition of Scale AI by Meta, it genuinely seems to have created a window for Innodata to gain market share as clients might be looking for alternatives or diversifying their vendors.
The competitive disruption they can leverage?
Potentially, yes. And continued investment in their own platforms, like Synodex, which focuses on medical records,
Yeah.
and Agility for PR marketing data, could lead to further revenue diversification down the line, reducing reliance on that single big customer.
Then finally, the threats. What external factors could derail things?
Competition is always a threat. They operate in a highly competitive space against well-capitalized rivals. They absolutely must keep innovating just to stay ahead, given how fast AI technology moves.
Constant pressure.
Constant pressure. There's also that ongoing shareholder lawsuit. Even though the DOJ and SEC backed off, the lawsuit itself still exists and poses potential reputational and financial risk until it's fully resolved.
What about broader economic stuff? Inflation, interest rates.
Management seems relatively optimistic there. They believe Innodata is well-positioned because its key clients, those magnificent 7 types, are likely to continue heavy AI-related capital spending regardless of broader economic conditions. So they might be somewhat insulated.
Okay. And any specific mention of those U.S. tariffs from 2025?
Didn't see anything specific on the impact of those tariffs in the source material we reviewed. Doesn't seem to be a primary concern highlighted for Innodata at this stage.
All right, we've dissected the business, the management, the financials, the market view, the ownership, and the risks. Let's bring it all together now in Chapter 7, our conclusion. Time for a synthesis of findings. Innodata really does present a complex picture, doesn't it? High risk, potentially high reward. It's not straightforward.
Not at all. Let's lay out the bull case clearly. This company has executed a truly remarkable turnaround. From losses to solid profits, becoming incredibly capital efficient with that stellar ROIC.
The numbers are impressive.
They are. And it seems to have built a powerful competitive advantage based on its unique mix of proprietary tech and deep human expertise. Plus, it has a stellar reputation with the world's biggest tech firms.
Growth.
Explosive growth phase, significantly outpacing the market, and it's all backed by a pristine balance sheet. Add to that, Wall Street analysts are overwhelmingly bullish, and big institutions are buying the stock. That's a compelling bull case.
Okay, but then there's the bear case. We have to give it equal weight.
Absolutely. First, the valuation. It's priced for perfection. Any sign of slowing growth, even if it's still good growth, could lead to a sharp stock price correction because expectations are so high.
The customer concentration risk.
Huge bear point.
Yeah.
Heavy reliance on a single customer for well over half its main revenue stream. That's a significant and immediate risk. If that relationship falters, it's a major blow.
And the insider selling.
A major red flag. Substantial selling by top insiders, including the chairman near the peak price. It directly contradicts the bullish narrative and raises uncomfortable questions.
Anything else for the bears?
Just the inherent volatility of the stock. Well, the fundamentals look strong now. It's a very choppy stock, and the recent price action has been technically bearish, trading below those key moving averages. Now, summarizing the valuation summary again. Professional analyst consensus puts the estimated intrinsic value between $55 and $75 per share.
Compared to the current price of $37.98. So, analysts see a lot of upside potential, despite the risks. So let's wrap this up with our concluding outlook. What does this all mean for you, the listener? Innodata's fundamental transformation is undeniable. It's become a highly compelling growth story right in the thick of the AI revolution.
The turnaround is real, the growth is real, the profitability is real.
However, its current valuation is demanding. And the business risks, especially that customer concentration and the significant insider selling, they absolutely demand caution. You cannot ignore them.
They are significant counterweights to the bull case.
So, for whom might this stock be suitable? Perhaps for a long-term investor with a genuinely high tolerance for risk. Someone who strongly believes management can navigate these challenges, successfully diversify the customer base, and keep executing on this high-growth trajectory.
Right. If you believe in that execution story, then maybe the current price offers an interesting entry point.
But let's be crystal clear. This is truly a speculative growth investment. It is not a traditional conservative value play by any stretch of the imagination. High potential reward, yes, but also very high potential risk.
And Maybe that leaves us with a final provocative thought for you to chew on. We're in this world where AI is just evolving at lightning speed. Tech giants are pouring billions into it. How crucial, really, will Innodata's specific blend of proprietary tech and that network of 5,000 plus human experts be in maintaining its edge long term?
Can they stay ahead?
Yeah. Can they defend their moat against those very tech giants, their own customers, who could potentially decide to build similar capabilities entirely in-house? That's the long-term strategic question, isn't it?
What an incredible deep dive. Really fascinating, complex company.
Definitely keeps you thinking.
If you found these insights valuable today, please do remember to like this video and subscribe to the Stock Analytics AI YouTube channel. It helps us bring you more deep dives like this.
We appreciate the support.
And remember, members get priority. For just $4.99 a month, you can request deep dives on specific tickers. We're tackling the entire S&P 500 over the coming months, and members get first look, exclusive priority access.
Or drop a super thanks if you want a specific one-off analysis.
Exactly. Now, before you go, the crucial reminder. This analysis was generated by an AI system. It's for educational purposes only. It is absolutely not financial advice.
Please do your own research, dig deeper.
Or consult with a qualified financial advisor before making any investment decisions based on anything you've heard here. Thanks so much for joining us for another deep dive.